of and demand for liquidity. You could actually have more sellers than buyers and the price will still go up, as you can see from this example on the screen. So it's not just about buyers and sellers. Prices really move when customer demand exceeds the supply of liquidity in that direction. It is that interaction between customers and market makers, which is why I've been emphasizing over the previous 3 lessons the importance of tracking dealing desks and market makers. What it's really saying is prices will move in the direction of least liquidity relative to demand. That is a mathematical certainty and it's an indisputable fact, and every economist on the planet will confirm that for you. It is just basic market mechanics, and this is where it gets really interesting. If you could identify when customer demand is greater than the supply of liquidity on one side of the market, you could predict with 100% certainty which direction the price was going to move next. And that's a pretty exciting proposition because it would give you a 100% win rate with your trades. Now, unfortunately, the Forex market isn't that transparent. We can see a great deal of the customer side orders, as we'll discuss when we move on to the core volumes indicator tomorrow, but we can't see all of them, and it's tricky to know for sure whether the price change was due to a real transaction or just triangular equilibrium. But let me show you this scientific paper that was produced by 3 researchers at Stanford University. They found that by just measuring the liquidity volumes, they were able to predict the price direction 81% of the time. And this wasn't a small backtest either. They made 2.5 million observations to ensure that these were statistically reliable results. All they did was compare the amount of liquidity on the bid side to the liquidity on the offer side. If there was an imbalance, 81% of the time, the price moved in the direction of least liquidity. Now that's quite incredible when you consider they weren't able to factor in the customer side activity. They effectively only used half of the price equation by only studying market makers, not the dealing desks, and yet they were still able to correctly predict future short-term price direction 81% of the time.